Morning, everybody. I'm super excited to welcome Matt Burris. Matt, welcome.
Thanks for having me, Sugata. It's a pleasure to be here.
I know we have chatted a few times, and
Mhm.
it's an exciting time to be in this industry. Everything is changing, and it seems like everybody's going to get out of business. There will be no jobs left. But on the other side, there's a lot of promise, and I'm here to talk to you about the promises. But before we get going, it'll be amazing if you can take please a couple of minutes and introduce yourself.
Sure. My name is Matt Burris. I'm a partner at the 9.8 Collective, where I'm in charge of insights around venture studios. I'm also a senior director of research at the Venture Studio Forum, which is a nonprofit trade association that we started with the mission there is really to elevate the asset class and really formally establish it. Because venture studios, they're our passion. It's an amazing business model. You can build any kind of company you want, which provides a ton of flexibility, but also a ton of challenge when you're trying to build one.
So we'll get into that. But
Oh,
before
yeah.
you get into that, let's talk about how you got into it. So you have a terrific background. You've done a lot of stuff. So why don't we discuss a little bit the journey that you have gone through to get to this point?
Yeah, I was a venture funded startup founder. I was building a metal 3D printer company in Bloomington, Indiana. And I got some advice from a local group that turned out to be called a studio. And they helped me get into an accelerator in the Bay Area. But that studio, actually, the founders there are really good friends with the partners that came together to start High Alpha in Indianapolis, Scott Dorsey and a few other folks, and really influenced the design of High Alpha. So I got exposed to the venture studio model in a few instances right around like 2008, 2009 timeframe. And that influenced me a lot over my career. I looked at engaging in 5 or 6 different versions of a studio. Tried to build one inside of NCR. COVID hit, budget got froze, so that didn't happen. But I went through the GSSN boot camp on Venture Studios. It was an 8-week program. You had partners from 8 different venture studios in teaching different modules. And coming out of that, one of the facilitators, Al Paracellan from Enhanced Ventures, like everybody needs to get on LinkedIn. This is one of the best platforms to connect with potential investors, potential follow-on capital sources, and entrepreneurs you're going to partner with to build companies. And so I'm like, I've never been active on LinkedIn. Okay, I'll do it. So I wrote up 5 posts, put them on LinkedIn Monday through Friday. I had about 100,000 impressions at end of that first week. I was like, okay, this works. And then in December, 4 months after I started posting on LinkedIn, I went viral. I got 1.5 million impressions on one post. And 500 DMs later, 100 of them were people saying, hey, you seem to know a lot about venture studios. Can you help me? Okay, I've read about these situations. This is when you're supposed to say yes and lean in and find out what the world is really calling you to do. And so I did. That kicked off what has grown to be over 500 conversations with venture studios all over the world. And I've gotten to dig in and see how they've organized themselves, how they build companies, what their strategy is, their thesis is. So it's been really eye opening. And that's let me create a lot of foundational like design practices for how you would organize a venture studio and how you really even define it. And so our definition of a venture studio is it's a company that builds other companies by playing 3 core roles in every company it builds. It's always going to be an entrepreneur, an operator, and an investor. And that's really critical. And it's very distinct from everything else out there.
We will get into what a venture studio is, but can you talk to us a little bit about, because I know with all of these studios that are involved with kind of global basis, what are the hotspots are from we see a lot of market data where VC capital is going in, but
Mhm.
that's not the only place where startups happen, right? There are other places, there are different sources of capital, especially when you're starting up. So can you talk to a little bit of this ecosystem of money from a macro perspective? Where do things are, where things are flowing, what kind of categories they are?
So in the studio world, it's interesting because you don't have to just build for venture capital within a venture studio model. You can build with a private equity exit in mind. You can build deep tech. You can build just boring old businesses. And when you have that kind of flexibility in what you do, the capital sources you can actually pull in are a lot wider than just VC. So we've seen studios leverage public financing, some state level debt vehicles to provide up to half of their initial capital, which is frankly amazing. It's a great way to ease that burden of getting started and really lower the risk for the other investors coming into the studio as well. But that's just one of dozens of different sources of capital you can really start taking advantage of. And honestly, I'd say this is one of the most untapped aspects of the venture studio model today. Because if you know a certain style of financing is available, you can build the venture studio around it and leverage that. And it's going to change the economics of the studio, and it's going to change what you build and how you build it.
Let's take two tracks, separate tracks.
Yeah.
One, we're going to focus on entrepreneurs, which you used to be, and then you moved to the other side, became entrepreneur. And because I also came from large companies, and from an entrepreneurship perspective, they're called new ventures, literally, in these companies. Whether you look at, and 3M possibly pioneered it in the early days, a
Mm-hmm.
lot of companies emulated, whether it's Intel and others, and they have their own capital arms. So from an entrepreneur perspective, funding wise, traditionally, it starts in the research lab. Therefore, they have access to NHS and a whole bunch of other sort of government related funding, state related funding. They have different avenues. They work with research universities. So can
Mm-hmm.
you talk about that ecosystem? But it's very different than entrepreneurship. And then we'll go into the sort of the entrepreneurial side.
Yeah. No, it's very different. And I've spent, let's see, 2 years in national labs and 6 years in corporate innovation. So I've gotten exposed to a couple different aspects of this. And the challenge always is you can often get some funding or get some internal support to start building something. You can even get some decent results, like promising results. Hey, we should go pursue this. Moving to that next stage is always where you're going to run into some significant challenges because the roadmap in a large company has already been defined for the most part. It might shift on an annual basis, but if you're trying to insert something new in, the reality is there's no budget. The teams are already overloaded. Everything is already accounted for. You're not going to put this new thing in. And that's actually where we see the studio model playing a really interesting role is a studio fully encapsulates all the skill sets, all the capabilities you need to actually take an idea or an opportunity and take it all the way to market. So you're not dependent on all the rest of the resources being available, signed off, available when you need it. It's all there in the studio. And that really shortens the time horizon in an entrepreneurship drastically.
Do you think, from personality wise, because when I think about these large research labs in Fortune 100 or even 1,000 companies, they're well structured. Like when I left my previous large Fortune 100 company and started ZINFI, first time I realized how much lawyers cost. Because for me, it was just a couple of blocks away in another
Mhm.
building. I had to go over to meet somebody to file a patent or do something, right? So when
Sure.
you're an entrepreneur, there's a lot of resources that you take for granted. When you come outside that environment, you just don't have it. And cash and competency becomes a real issue. But talk to a little bit about, do you see personality differences, people who are successful in building ventures within a company, because the mechanism of it is very different, right? Who reviews it, how many times you reviewed it, the reorg that you have to go through. You may not
Yeah.
have those on outside, have that freedom, but other things you don't have.
Oh, for sure. Like when I see a lot of the successes inside any major company, I think it happens in one of two ways. One, you have somebody high up in leadership that is your champion, that is often early in that role. So they're going to stay there a while and they can be that champion through that transition period of what you're trying to bring to market. That's amazing. That's ideal. It's hard. If you're that innovator, that entrepreneur, it's really hard to arrange. That's just almost pure luck that it happens. The other approach is that entrepreneur has to be the person to make it happen. And it's often an incredibly long and brutal journey to do it. And you're going to go against often what your superiors tell you to do. Right? They'll be like, well, delay this. Don't go talk to customers. We'll get to it next year. But any entrepreneur knows that if you keep doing that, it'll never happen. And so the entrepreneurs I've seen have success, they've either arranged or taken advantage of opportunities that pop up to really accelerate the opportunities that we're working on, getting them in front of customers, demonstrating the value to customers, and then having the outside customer really put a lot of pressure on the corporation, like, hey, we need this now, bring it forward. And that has worked.
So if you take for our audience, just to simplify and frame it, maybe two dimensions. One is a resource dimension, low resources and high amount of resources. And then you take the risk dimension, low risk and high risk. Do you see patterns where whether entrepreneur versus entrepreneur tend to thrive on an outcome basis?
Anytime you're in that entrepreneur space, you definitely aren't seeing the resource constraints as much or at the same level, often just because you don't have visibility into what it's really going to take across the organization to bring forward a new product. And so you're a little isolated there. But the hack there is always ensure that there's so much value there that it just gets pulled out of your hands and then no one can stop it. But yeah, that blindness to know what the true costs are is a blocker. It's a really big blocker when you're trying to create the business case that we should go do this, because you don't know all the costs involved. You can't model the unit economics appropriately. And so anytime you start pushing it up to upper management, they're like, no, you missed so many things. Like, no, pass, bye. So yeah, it's definitely a struggle. And when you're outside, you tend to have a much better picture of what the costs are going to be, even if it takes you a little bit more time to figure it out, because you have to figure it out because nobody else is going to give you the answer.
Some of your writing, you have talked about these kind of three roles, right?
Yeah.
So can you flesh that out, what that framework is? And then
Mhm.
from entrepreneurship and entrepreneurship perspective, do those characters change around the founder?
From a studio perspective, studio is going to come in and play these three roles we've defined. They're going to be an entrepreneur, an operator, and an investor. And so you see this in all of the entrepreneurial support ecosystems. These roles all exist, and each model of entrepreneurial support plays a different set of roles. Studio is interesting because it plays all of them. And if you're building a company, you have to have all of them, right? There's no way around that entrepreneurial role, where you have to figure out what this opportunity is, shape it through 0 to 1, get that customer buy-in and proof that we should go build it. You got to build it. You got to put all the operations support and infrastructure around what you're going to deliver so you can deliver it and keep the customer happy. And all of that takes capital. Where that capital is going to come from is going to vary. But all of those elements have to be there. And in a lot of the entrepreneurial and entrepreneurial support approaches, these are not integrated roles. They're independent. And so now you have to bring different groups, different orgs together to attempt to get the right support to move something forward. And it just gets more and more challenging. So pulling all of these together, providing all the capital, the operational support, and the entrepreneurial support all in one just lets you move faster, much faster.
I did a podcast with Michael Gerber, that famous book for E-Myth,
Mhm.
and he talks about three different personas in a founder. From a structure perspective, when you think about venture studio structure, what I would love to do is spend a few minutes on the venture studio structure, because
Mhm.
every founder is different, and then construct behind the founder, like if you're doing in a large company versus all your own, is different, right? So maybe you can talk a little bit about
Yeah,
what the venture studio structure is and how does it compensate for, maybe amplify the strengths and compensate for the gaps for a founder.
for sure. One of the frameworks I use is the 4 customer framework. A studio has to serve all 4 customers for the studio model to work well. This is the investors in the studio, the staff and the GPs that are going to run the studio, the follow on capital that you're going to build this company for, and they're going to continue to support it. And of course, the entrepreneur or entrepreneur that studio is going to work with to build that company. For that last one, when you know what you're going to build and how you're going to build it, what success looks like, so that the follow-on capital sources are like, yes, we're absolutely backing this. This is great. And now you can start to figure out, what that entrepreneur looks like or entrepreneur. And now the studio can sit here and go, okay, based on who they are, what support do they really need from us? That support looks radically different if you're working with a serial entrepreneur with exits versus a career professional that has maybe never done anything entrepreneurial in their life, but they've got 20, 30 years of corporate experience. They know this industry inside and out. Their gaps, the support that they need, looks very different. There are studios that support students just getting out of college or even high school. And again, the support that those people need to be successful looks a lot different. And so this is one of those dimensions of a studio, like as and define who you're going to support, you can start to really understand what kind of support do they really need. And it does look very different.
So when you look at sort of the tier one VCs, whether it's Andreessen Horowitz or Khosla Ventures or any of those Sequoia, etc., they have moved into these operating resource framework environment. It's not just capital. We bring you an operational framework who have done it before, and they have a large network of advisors who have done it before,
Mhm.
and then connections to customers or governments and other access paths that you need. So within that context, tell us a little bit about how is Venture Studio structured to that or different from it?
Very similar. I think the subtle difference is really about control. So in a studio model, the studio is going to have a controlling role as an entrepreneur, as an operator, and as an investor. A VC definitely has a controlling role as an investor, right? They put some protective provisions in place. They've got a seat on the board. They can make sure that the capital they provide is being used appropriately. Now, if you look at somebody like Andreessen Horowitz that has a really big ops team that can come in and help build that company, do they take any control in the ops? Generally not. They're there to help, right? They're not getting in there and say, hey, no, we need to retool everything you've done. We got to do this. So they're like, no, they look in many ways like an outside agency that this startup is hiring to support them. They might provide some advice, but they're not going to take ownership, and they're not going to say, this path we will not go down. We need to go down this path. So it's a subtle difference in that relationship. And that applies over on that entrepreneurial side as well. You're not often going to get a VC in there who their day-to-day role is to say, no, we need to do some really big strategy retooling, and I'm going to get my hands dirty. I'm going to hop on customer calls with you. We're going to figure this out. That's what a studio would do. So definitely there's some overlap, but that control element, and one way to look at the control is the venture studio is a co-founder. They've got to vote on how things are going to go down, just like any other co-founder. But they're not going to necessarily dictate it has to be this way. But when their voice is in that room and they're a peer, they're going to have heavily influence the direction. And because they put so much time in and they know the space very well, which is, I'd say, a very big distinction with the other models. You're going to trust their advice a lot more because they've been in the room with you. They've talked to customers. They've been building this beside you for a long time. I just ran some numbers on some research we've been doing, and the preliminary numbers show that a venture studio provides about 100 times more hands-on support than an accelerator does. So we're talking thousands of hours of support versus an accelerator program is usually like 1 to 3 hours of support per week for 3 months. So you're in the 20-ish plus or minus hours of support versus 3 to 6,000. Like it's such a world apart.
So let's double click on some of those words
Yeah.
that you just said. So in one side, you have these kind of traditional VC model, but they have tiered now. You have these large tier one players. They really bring an ecosystem with them in a
Yeah.
certain category that they invest, right? All the way from research labs to go to market to technology bench strength. If it's in manufacturing, access to markets, capitals, build beyond just a proof of concept pilot. So you have that dimension. Then you have the tier two, tier three VCs who are writing your check, wants to be on your board, and then some mechanism of access to resources. So let's put them in one bucket. Then you got this other bucket, you have used certain terms like venture studios, accelerators, incubators. So can you flesh those terms out a little bit on the other side? What are meant by those different things?
Yeah, there's a few things that we'll pick them apart. An accelerator is typically going to come in and spend 3 months with a startup, usually in a cohort environment, and they're going to provide some education. They're going to provide a little pressure to move that company, ideally a little bit down the line so that they can go raise capital. Usually it's very early stage capital. It's usually a common program for everybody. It's not customized. Everybody's going to run through the same sort of module. So it's very structured. And that model has kind of got developed in the early 2000s and really grew shortly after 2010, I believe, and had a lot of resistance from venture capitalists because some of their questions kind of and concerns mirror what we're seeing in the venture studio world today, which is if you have a great founder, why would they give up 6 to 10% equity for so little money when they could just raise a much larger round of capital? And we've seen that the accelerator, one, often acts as a filter for better quality deals for upstream VCs, which is always great. But it also forces people to go through, learn the basics, what they really need to do. And something a little bit better quality is coming out, right? There's some value in that no matter what. A venture studio is going to come in. It's not usually a cohort based program. Sometimes they start that way, but the support that any company needs, because a studio is going to typically provide support for around 12 months. Some are 24 months or more, some are a little less than 12 months. But the support a company needs from zero through the first 12 months or so of life is often very different. The timings shift as a company is making progress. So a studio is going to support it a lot differently, a lot more customized. But often a studio is going to come in, go through ideation, let's find the right thing to go build, let's validate it, then let's start building this thing up. Then we're going to grow the company, then we're going to spin out. Let's take 5 stages of support. Every studio is going to customize and really design how they support those companies based on the type of companies they're building. So you can imagine a studio that builds biotech companies, right? The needs of a biotech company are radically different than the needs of a software company. If you don't change how you're supporting those companies, you've missed the mark. Now, if we look at a very different model, venture capital, which is primarily about making an investment, selecting from the best deals that you have available to make those investments, the support you're going to provide post-investment is relatively minimal because you just don't have the bandwidth, right? Most venture funds are trying to look at 2,000 deals to filter down to 1 or 2 a year they're going to say yes to per partner. That's a lot of work to filter down those deals. So you're not left with a ton of time to support the companies in your portfolio. Adding in additional like operations teams that can provide some support, that's great. But, and I know venture funded founders have had this complaint forever. VCs love to come in and say, we add a ton of value. Okay. You make introductions to your network, which is great, but it's really just, hey, here, you guys should talk, right? It's the handoff. And with a big network can provide that. It's not really unique. And the vast majority of founders can get access to similar networks or hustle and get the same impact. So it's not a massive value. However, there are venture funds that play more of a venture studio role. And one of those is CyberStarts out in Israel. They've got a 12-month program that they run entrepreneurs in residence through, where at the end of that program, they need to make $1 million in ARR. But the start is, hey, we happen to have a great network established, 70 plus chief security officers at major corporations that are going to come in and talk to you about the big problems that they are not finding solutions for, that they need solutions for. And they're willing to work with a startup to build it, and they'll buy from a startup. And so this seeds really valuable problems that CyberStarts can help build out with that entrepreneur in residence. And it really starts them on a great trajectory. And they've had a couple of nice exits recently, $28 billion exit to Google, I think, recently.
So I guess when the other part, double clicking on this venture studio concept and comparing to the traditional VCs, there's a lot of money. That the sizes of money at play is very different than it was 10 years ago, even though interest rate remains high, but a lot of powder sits on the sideline for looking for deals.
Yeah.
And that has also led to, and you have written about it, stratification of capital, the LPs behind these different entities that actually does the forward-looking investment. So are you seeing these portfolio companies that you're working with on venture studio side? Is there a different, because success is a function of expectation, right? So
Mm-hmm.
when you look at the big bets that Andreessen Horowitz or Sequoia and others are making, they're trying to go after, and because the reward has to be so much bigger, is things that are impossible. Like they look impossible because when you solve it, the
Mm-hmm.
rewards are really big.
Sure.
Is venture studio is now filling what VCs used to be before, or are they different in natures? Because the LPs that are putting in money, they have a success criteria in mind, and therefore they have an expectation in mind. So can you tell us a little bit on that?
Yeah, if I look back at the history and like the evolution of venture funds and venture investing, I'd say there's a lot of similarities between modern day venture studios and the really early stage or early venture funds, like 70s time frame. I've been looking at some academic papers to write something about this. And the data shows that venture funds and even angel investors back then were a lot more hands on in the companies that they backed than they are today. And they did take on active roles within some of their portfolio companies. So they started to share a lot of those aspects that we see with studios today. The big difference is they were structured more as investment vehicles, venture funds. So they were really limited as far as the staff that they could have. Venture studios realized that staff limit really prevents improving the quality of outcome. Because if you can actually have any founder that's been down this path the first couple of years, it's brutal. It's you, maybe a co founder, you have probably no money other than what your savings account is, and you're trying to make it work. You're trying to build it. It's just a brutal couple of years. And if you had at the very beginning capital, a team that could help you build and validate this thing, and somebody to advise you and really put this opportunity through the pressure cooker to make sure that is this something worth spending the next 7 to 10 plus years of your life on? If that was their day one, a lot of founders like I would. That's amazing. Spend 6 months to 12 months trying to raise capital to go do this. If I have it day one with a team that can help me do it, and then wants to make sure that I'm successful and is going to pull me away from anything that isn't promising enough to spend that kind of time on and capital on, beautiful. So I think what we see with the venture studio model is an evolution of some of those early, more hands-on venture funds from the 70s.
So let's talk a little bit about that. When you look at sort of the LP, as little as they disclose, is that when you look at the composition of the LP in this tier one, you take the top 20 or top 30 VCs, they're sovereign funds, and
Yeah.
their scale of investments, capital coming in, SoftBank possibly on the other extreme, but is very different, right? Time horizons different, expectations are different, check sizes are different.
Mm-hmm.
It's a very different league. And then you have on angels and tier two, tier three VCs who manage 150, 200, maybe at the most a billion AUM, which in the old days seemed to be a lot of money. It seems like there's quite a few companies with that, and they're also struggling. Now, what is the typical fund size of a venture studio, and what is the composition of those LPs? Because I want to come back to some of your
Yeah.
concept that you talked about, this quality first revolution and etc. I want to understand is that going back to that notion, I'm putting money in, I have an expectation that defines success. So in
Sure.
this first group, the success is very different expectation of and versus what is the expectation
Very
from these
different.
LPs in venture studios?
Yeah. A lot of venture studios, the fund size is going to be a lot smaller than we talked about. 10, 20, 30 million is a normal operational range. We've seen 50 plus. The largest out there is about 5 billion. That's flagship pioneering biotech studio. But the vast majority of venture studios are in 100 million or less in fund size. So their approach is a lot different. And some of this is due to some of the drivers that you would have to have for the larger fund size. You're not making as many companies, or you're not making as many investments because you're building companies from scratch. So there's only so many companies you can build and provide enough support to that the quality remains high, right? The other extreme, venture capital, it is about making a more diversified set of investment bets, right? Because you only need one or two of them to really succeed to make the fund back and make all your investors really happy. From a venture studio perspective, yeah, that is one investment approach. Let's play the power law. From a venture studio perspective, let's make every single one of these companies successful. We're also a larger equity owner than a typical venture fund, significantly. Usually it's in the neighborhood of 2 to 5 times more equity. That's substantial. Most venture funds, when they make an investment, if you look at Carta's data, for example, around seed, Series A, it's usually about a 20% dilution. But usually that's split across two venture funds. So each one of them is taking about a 10% position. A venture studio is, I think the average equity position after spin out is around 35%. It can be a lot higher. The range I've seen, and it all works, 15 up to 90%. It varies drastically by industry, right? You imagine biotech looks a lot different than software. If you're building for companies to go into venture capital, it has to work for venture capital. So those higher end numbers don't work for venture capital because the founders have taken way too much dilution. But if you're building a company for private equity to buy, then it doesn't matter because the cap table effectively gets reset on that acquisition. But yeah, venture studios, much different dynamic, much smaller funds, much smaller cohorts. 10, 20 companies is considered fairly high for a cohort size. If 20 companies built over 3 years, you're building at a pretty good pace, 6+ companies a year.
So let's talk a little bit about, maybe take a midpoint of a venture studio. I don't know whether it's 30 million, 50 million, 100 million. Pick a fund size. Then maybe you can walk us through that ecosystem and the rounds that they do. How do they vet? Who is involved? Unlike family offices, do they have operating staff? Like, how can you deconstruct that ecosystem?
Yeah, a venture studio, most of the LPs that are going to invest in them today look like family offices. High net worth and family offices probably account for the 60-70% of the capital that flows into studios. There are a few institutional investors that have backed studios. Usually this is because the founders doing the studio have good relationships with those institutional investors, and the institutional investors already trust them. But today, family offices are the primary source of capital. Within a studio itself, you've got a larger ops team. The numbers that we typically see to run a studio effectively, you're usually in the range of 40 to 60% of that total fund being spent on operations. So if we take a step back real quick, we look at a normal business, you've got your cost of goods sold and you've got your SG&A. In a studio, your cost of goods sold is now the cost to build companies, right? You're building companies, you're taking an equity position in them. That is your whole business model, is to grow the value of that equity and liquidate at some point. That's how you drive your returns. Because you're playing a very active role in building, your cost of builds is fairly high. You've got a little bit SG&A, a little overhead, but then you've got 3 other areas where you're going to spend money. One is the formation capital to start that portfolio company in the very beginning. Then you've got the capital you're actually going to invest in that company and usually it's a preferred position. And then you might have a follow-on reserve. So it mirrors in many ways a venture fund. The difference is we're going to take some of that investment dollar and we're going to apply it over as operational spend because we're actively building the company. When I talk to family offices and institutional investors, the way I describe this is, imagine an ops heavy private equity fund that starts companies. That's a venture studio. And it actually links up to a lot of typical processes and frameworks you see in a private equity firm. They've got a very good process due diligence. They've got a large operations team where this is a very sophisticated operation typically, especially when you compare it to venture capital, where in venture capital, you might make an investment decision and deploy capital in as little as a couple of weeks. Private equity firm is going to spend a lot more time, boots on the ground, doing the due diligence, going to talk to customers, going to on-site visits to understand, should we make this investment? Then they're going to get their hands dirty. If they're an ops heavy private equity firm, they're going to put operational talent in that company and help build it. And that's exactly what a studio does. There is that bigger spend, and it's the nature of the model itself.
So, Matt, when you think about, maybe, I know there is no average because possibly diversity is the strength in this ecosystem. But if you want to pick like maybe one or two examples of a fund and composition of it, types of LP that put in, the time horizon that they have, and the P&L perspective, how does that look like? How many deals they do? What is the expected horizon? Just maybe pick just one and then walk us through that construct. That'll be very helpful.
Do you want that from the LP perspective or from the studio perspective?
I think both, because I would love to know what that board meeting looks like, because it's all about horizon and what my expected return is, right? So maybe we'll do a little bit.
Yeah. The vast majority of venture studios out there are structured very similarly to a standard venture fund. So 10-year fund life, a couple year extensions. So it doesn't deviate too much from what you would normally expect in a venture fund. The difference really is going to be there's a lot more updates and a lot more due diligence on what is being built actively within the studio. So often your investment committee meeting within a studio is, okay, what's the progress of the companies you're building? Because they haven't necessarily left the studio yet. They're still inside. What's going on? What are the new developments? What's the prospective revenue coming down? When are we going to make the decision to deploy additional capital into any of them? Or are we going to have to make a call to kill it rather than continue to support it and reallocate our capital and our staff to things that are a lot more promising? So it's a subtle shift. Right? You're spending a little bit, you're getting a little more in detail on what's being built. But often, just like in a venture fund, the venture studio is going to be very selective on who is in those meetings and who's going to be on that investment committee, because they need to have an understanding of that model and know what it takes to go build companies and evaluate them in those early days when things are moving very quickly and there's a lot of uncertainty. If you get the wrong investor on that committee, you can imagine that's not going to play out very well.
So when you take a look at the tier one VCs, people are coming to them, put money in. When you look at the tier two, tier three VCs, they're always outselling because they don't know what the down cycle will look like. Then when you look at the venture studio space, like what does fundraise look like? How is it once every 3 years when they anticipate their 50% through their, like how do
they... So often, every 3 years is fairly common. Venture studios will often raise in what looks like a traditional fund vehicle, a 2 and 20 model. There's also some hybrid models out there and more evergreen models. But often, you're going to spend 3 years building. You're going to use the vast majority of your capital at that point. Because for a venture studio, follow-on capital is not nearly as effective within a venture fund. Because you take such a large equity position early on, follow-on gets really expensive. And you have to make a call, hey, I could have a follow-on reserve or I could build X number of new companies. What's the right play? But it gets every three years is very typical for the top tier studios that have operated for over a decade, that have lots of well-known high visibility successes. Fundraising is significantly easier. It's still not super easy. And the reason is the vast majority of LPs out there do not really know what this model looks like. So every time a new LP gets exposed to it, the studio is sitting here going, okay, here's how this model works. Here's how it is very distinct and different. Here's the value that is provided. Here's our track record. This is why you should consider an investment in this style versus where you would otherwise potentially deploy that capital. And so it is a little bit more challenging. I've recently talked to a couple of tier one studios, and a couple of them seem to have figured out some strategies to really make fundraising a lot easier, but they've been working on it for 20 years.
So speaking of time, I also want to keep an eye on time. I have a couple of more questions before we wrap.
Sure.
How new is this category? When did it start? And is it building momentum, or is there a rate of addition of these studios coming into the market? Can you talk a little bit about the trend?
Yeah, so it started roughly around 96, at least the modern version of the venture studio model. It is picking up. So it was very slow in the beginning. In the late 20 teens, early 2020s, it was growing at like 30% a year. And part of that is we don't have a good sense of all the studios in the world. So, as an example, last year we found a new studio that had been around for 27 years. MDB Capital, one of the most unique models I've seen. They license IP, they build a company around it, they raise one private round of capital, and then within about 2 years of that raise, they take the company public themselves. They're a fully licensed broker dealer. They've done it 17 times in IPOs, 5 unicorns, and these companies grew to become unicorns on the public market. They didn't go public as unicorns. So amazing success, like almost a 30% unicorn hit rate from IP, which is probably the best performing fund in that aspect I've ever heard of.
And you think there are about 500 plus or so out there now? What is the number?
I'd say there's several thousand. The last hard number survey anyone did put the count around 880, and that was done about 3 or 4 years ago.
Okay. So let's go to the other side.
Yeah.
To both an entrepreneur or an entrepreneur, how do they find it? Do they just call up Matt Burris and say, hey, Matt, I have an idea? Like, how do they find these studios? As we're trying to pull a network together here at East Bay Founders. We have 600 founders suddenly showed up, part of our network. We're trying to bring resources to them. So can you tell us a little bit about that?
If you go to the Venture Studio Forum, hopefully in a few months, we will have a really great tool for that. We're right now conducting a very large survey and doing a lot of research to try to identify all the venture studios globally and categorize them and catalog them in a way that you as a founder, you as an investor, you as a corporate, somebody that's looking to partner with a studio can identify the right studio for you. Right now, that's a challenge. You've got a couple of different maps that studios have put together of studios. You've got Deanna Lesage as a database that she's built and maintained manually that has things like what's the industry that the studio is focused in? Do they accept outside ideas and outside founders you can apply into the studio? But it's a very manual search today. And it's really tough to do the matchmaking right now.
So one last question from a structure perspective, and especially I want to come to this notion of AI. We didn't get a chance much to discuss. How much of that is you think is being used or going to be used next 12 to 24 months in portfolio management, in deal assessment, and then supporting the founders with some tools and frameworks leveraging AI?
That's a kind of a nuanced one in this space. The venture studio model is still growing rapidly. Like corporates have exploded. Several hundred new studios in the last 6 years just in the corporate venture studio space. But really today, I think we're going to see a lot of evolution of the model and of how studios support the entrepreneurs they partner with. They support the companies that they're building, and they support the ecosystem. It's not fully documented today. It's one of the challenges if you want to go out and build a studio. It's like, what are the best practices? That's one of the things that the Venture Studio Forum is working on solving, is to go out and document some of these, because some of these processes are flat out stunning. One of the examples I love is OSS Ventures in Paris, France. When I talked to them about their process 2 years ago, they had, at the time, 14,000 recorded and transcribed customer discovery calls, all linked to ICPs, to user profiles, with interviewer notes, and all loaded up into their own custom AI. So anytime they had a new idea inside they wanted to test, start there. And it would tell them, hey, you need to consider this. There's this aspect over here. And it would start mapping that opportunity out. That's amazing, right? That's not a capability you're going to see in an individual startup because you need to find one opportunity. Corporations have the capability of doing it, but I've never seen one with a really great system like that. In fact, usually spending 6 years in corporate innovation, you're told don't talk to customers because you might jeopardize a sales deal. So getting that access and insight is almost impossible. And in a venture studio, that 0 to 1, it has to be built into a sophisticated process because that is what makes or breaks what you're doing.
That's amazing. I gotta have you back. There gotta be a part two talking about the founder and their journey through these different vehicles. But Matt, thank you so much. I know we'll be talking offline, but thank you
Absolutely.
for your time. It's a pleasure.
Sure thing. Thanks for having me.